make money from the markets in trading, where you are doing pretty much the same thing on all different types of trading platforms. You're pretty much buying one thing, exchanging it for the other for a profit, or you're selling one thing, exchanging it for the other to make a profit. You can make money if you buy, or you can make money in trading if you sell something and then you sell it at another price point. More on this later in the video. And this isn't anything new. Us humans, we've been actually trading things for thousands of years. I'm talking about back in the day before even money was a thing. We were exchanging cattle for wood, or we were exchanging wood for some fish. Some people had goods that other people didn't have, so we were trading and exchanging one thing for another. Just in different amounts where one person was gaining and so was the other person. So it was an equal exchange because both the people had to do it. One person needed fish, the other person needed wood. One person needed the wood for fire, the other person needed fish to eat. And if you have an excess of each, instead of pretty much you're not using it, you exchange it for somebody else for something that you need. So now in Forex trading, we're obviously not trading fish for wood. We're trading one currency for another currency. For example, the euro being traded for the US dollar. The US dollar being traded for the Great British Pound. Have you guys ever gone to the airport and as soon as you get off of the plane, you see these big exchange money spots that you can pretty much go to, and if you're in a different country with a different currency, you can exchange $100 for $100 of that currency's actual physical dollar. We have all actually participated in the currency exchange participation. And this currency trading happens every single day. I'm talking trillions of dollars. Yes, trillions, not millions, not billions, trillions of dollars that are being exchanged every single day. To have the exact number, it's actually $6.3 trillion is moved in the market every single day. So when you're trading the foreign exchange markets, you're trading one currency for another, but you're not actually buying currency tangibly. You're not going to get this money in your bank account, or you're not going to hold it in a reserve account or in a different exchange. You're not doing any of that. You're simply betting if price will be going up or if price will be going down. You're essentially betting that the currency will get stronger or weaker versus the other currency. And the way that this works is by fundamentals. It's by the government, by the interest points of that country, by the banks behind that country and their funding, by the economy of each and every country. And if the country gets stronger than another country, that currency will rise, making it stronger than the other currency. So there's a spread there that it will go up in value. You make money on that spread. And let's say if a currency gets weaker than a different currency, then there's supposed to make money on that as well. For example, let's say that the US has had a recession and the euro is actually in a booming market. That means that the US dollar is going down and that the euro is going up. This is where you would want to buy the euro and where you would want to sell the dollar, because the market is clearly bad with the dollar. So you want to put sells in that the dollar will go down. You want to put buys in that the euro will go up because it is doing better than the dollar. It's almost a win-win scenario because the fundamentals are driving price down for the US dollar and driving it up for the euro. Now, bear in mind, you're not only just buying the euro, or you're just only selling the dollar. You can't do that. You have to bet on a currency pair. It's a pair, well, it's, you know, two things. It's like when you have a pair of shoes, you have your left shoe and your right shoe. If you have a pair of sandals, you have your left sandal and the right sandal. So when you have a currency pair, you have one currency pair and then another currency pair. And what they're doing is they are together battling each other. Who gets stronger than the other? Who's driving price up and who's driving price down? So for example, let's use Euro USD, which is the most known pair in the whole entire foreign exchange market. It is the most traded currency pair in the whole entire market. It has the most volume and the most movement, meaning that there's more opportunities and how you can actually capitalize off of it, but more on that later in this video. So when you're actually trading the foreign exchange market, you have to trade on a currency pair. Euro USD. If you were to buy Euro USD, you are betting that the euro is going to get stronger than the dollar because the euro drives price up. And if you were to sell Euro USD, you are betting that the dollar will be stronger than the euro. And that is because in the Euro USD pair, the euro is the base of the currency pair, and then the USD is the quote. So basically the euro is what drives the price up, and then the USD is what drives the price down. So if you see the price going up, that means that the euro is getting strong. And if you see the price going down, that means that the USD is getting strong. So if you want to bet on the dollar getting stronger, you have to sell Euro USD because the US dollar is going to get stronger than the euro. And if you want to buy Euro USD, you are betting that the euro will get stronger than the dollar. And this works for all currency pairs across the market. For example, GBP USD. It's the Great British Pound versus the dollar. So if you buy GBP USD, you are betting stronger than the dollar. And if you are selling GBP USD, you are betting that the dollar will get stronger than the pound. And in the foreign exchange market, there's thousands of pairs. I'm talking literal thousands. Like you can have the US dollar against the Mexican peso. You can have the Mexican peso against the Russian dollar. And that is the beauty of this market. There are so many different types of opportunity because there is so much more money being moved than the stock market, than the futures market, than even the crypto market. There is $6.6 trillion being moved every single day because this is a market of the whole entire world, of all the currencies in the world combined in one single market. Compared to the New York Stock Exchange or US 30, you're only dealing with the companies inside of the United States, which can only be so big. So that is pretty much a very entry level of what Forex is. Now there is many markets out there like futures, commodities, cryptos, options, and there's great opportunities there, but nothing compared to Forex. So now let's actually dive deep into actually how this market works and how you can learn everything you need for you to be able to go battle this market every single day. So now that you've seen that there's different types of currencies that you can actually trade all around the world, now there's actually different types of formats that you can trade. There's different types of way on how you can approach these different types of currencies that they all move very different. So to begin with, you have scalp trading, which is known as the lower time frame traders. These are the traders that have the faster movements, that they're in the market a lot less time. They have a higher win rate, but a lot less of a risk to reward. These are traders that usually are kind of stuck in front of the market the majority of the day or the majority of the night, that they have to dedicate hours sitting in front of the computer to just find one little good opportunity because they're only in the market probably within 1 to 2 movement, which they can either be winning very fast or losing very fast. And some scalpers can either enter 1 to 3 trades every single day in order for them to make some money or just make back losses from the previous day, because the majority of the scalpers will lose the majority of the time because they're taking a lot of trades constantly. And scalp trading is actually the most attractive type of trading that beginners kind of approach to it because they just passionate about trading and they want to be in front of the charts as much time as they can. So they approach scalping thinking that's going to be the best way for them to make money. Next, it leads me to day trading. So I'm sure we've all heard the term, oh, he's a day trader, or I know a day trader. Well, it's actually a very common term because it's what the majority of the people that work a 9 to 5 attempt to do. Because for you to be a day trader, you pretty much have to be in front of the markets while you're in a job. So people kind of treat it as their side income. And day traders are usually in front of the markets a little bit less time than scalpers, but they are definitely taking a lot less trades. They would be taking maximum 1 trade every single day, because anything more than that, you fall into the category of scalping. And day traders are a bit more selective when it comes to the trades, and their trades can last anywhere from 1 to 3 days to play out. Unlike the scalpers, that their trades can last anywhere from 1 to 2 hours. So day trading, your trades are actually being held 1 or 2 days compared to scalpers, which is a little bit of a time. Next is going to be swing trading. So swing trading is actually a approach of the market where you are swinging the market, meaning you're just chilling. You're going to be in maybe one position a week, maybe two positions a week if you find a good probability trade, and you'll hold it throughout the weekend. So you'll be in the position for anywhere from 4 to about 8 to 10 days. And these positions usually run a lot longer, giving you a lot more profit. And you actually have to do a lot less work. You're probably in front of the market for 1 to 3 hours every other day. You don't have to be involved in the market that much, because as soon as you enter a trade, you're pretty much letting your trade ride until it goes in your direction or against you. But swing traders are taking a lot less trades, but they are risking a lot more compared to the day traders and compared to the scalpers. And swing traders usually tend to have the highest win rate because they're being very, very select on the type of trades that they take, because they're only taking anywhere from 1 to 2 trades a week. And then next is going to be position trading. So positions trading is a trader or investor that pretty much enter a trade with a long-term vision. They want to be in the market for anywhere upwards of a month, and they are not looking to liquidate their position anytime soon because they're treating it as a investment, as a position that they're entering in the market. So they're prepared to be involved for about 1 to 2 to 3 months to just simply have their trade get as much profit as it possibly could be. And position traders or investors, they'll probably take 1 to 2 trades a month, if any. Usually they stick to 1 trade a month because they're looking at the market long term. They're not looking to have any short-term gain, and they're looking to minimize their losses as much as they possibly can. And investors and position traders are actually the ones that lose the least, because even if their positions go into a loss, they're going to continue to hold it long enough until it goes into profit. And if you hold a trade long enough, it will go back into profit. So as you can see, every single format of trading actually scales up on the amount of time that you're actually holding a position. A scalper is involved in the market anywhere from 1 to 2 hours a day. A day trader anywhere from 1 to 2 to 3 days in the market. And you have a swing trader where it's anywhere from 4, 8 to 10 days. And then a position trader where it's upwards of a month. So every single different type of format in trading, they are actually holding their trades longer, but they're actually taking less trades. So as the formats, they scale, so does the time they hold the trade, but the amount of trades they take is a lot less. And all of these different formats you can actually apply to all of the markets. You can apply it to foreign exchange trading, to commodities, futures, options, crypto, everything that has pretty much a chart with candlesticks that go up and they go down. But the best one, and the one where I've had the best experience and the most success, is going to be Forex trading. That is because it offers the best that no other market can offer. It has 24/5 access, meaning you can trade Monday through Friday, any hour out of the day. So if you work a job, you can trade when you get out of your job. If you're up late at night, you can trade late at night. If you're up early in the morning, you can trade early in the morning. Compared to, let's say, options or stocks, you can only trade 9 to 5, which kind of sucks, because if you have a job, you can't get involved in the market. You're simply limited to what you can actually do in the market. The next reason why it's my favorite and why I got involved is because the entry barrier. For you to get started in Forex trading, you can start with as little as $100, or compared to the stock market where your entry barrier is going to be $25,000 as your minimum first investment. And I don't know about you, but when I first started trading, I did not have that kind of money, so I simply couldn't get involved. Another reason why it's the most reliable is because you're literally trading money. It's impossible that the currencies of the world simply disappear from one day to another. If that happens, we're in a big problem, but that will literally never happen. Compared to a company in the New York Stock Exchange, they can simply just go bankrupt one day or get sued and you're done for. Or a crypto can pretty much get rug pulled and all your money is gone from one day to another. The currency exchange market is here forever, and it is going to be here forever. Countries run on these currencies, and they need to do that for it to keep going. For that reason why the currency exchange market only gets bigger year after year. and the opportunities are going to be there forever. And adding up to that, you can actually get involved for free. You can actually, don't worry, and we're gonna get into more details. For now, I'm just gonna pretty much go straight to the point just so you can see how you actually calculate the risk and how this platform works. So this right here is going to be a total of a 40 pip stop loss. What is a pip? Again, I'm gonna explain this later into the video. It's literally the next subject that is coming right after this. So right here, you would have a 40 pip stop loss, and then the lot unit we stay 1. I'll explain this later down the video. You simply click calculate, and then boom. Going to risk $50 on your account, and this is the unit or the lot size that you're going to use. It's that simple. All this platform does is calculate the risk that you want to place on your account. So you can place the amount of units, or you can place the actual lot size that you want to bet on this trade. Whether you're going to buy or whether you're going to sell, the same exact thing applies. As you can tell right here, there's no different option that you can put, oh, if I'm buying or if I'm selling, because the risk should be the same, whether you're interested in buying or you're interested in selling. But more details on what these other different vocabularies are and how you can use them, because I know they can be very intimidating at the beginning, but they're actually very simple. So now that you understand where you can calculate your risk, if you don't understand some of the words in there, don't worry, I'm going to explain to them. You're going to get them right away. There's one other platform that I personally don't use, but I can see a lot of you guys looking for somewhere to find it, and I'm gonna simply make it very straight to the point. I don't use this platform anymore because I'm a successful and profitable trader and I don't need to know these things, but I can understand as a beginner trader, it can create curiosity and you want to know where you can get a reliable source that's gonna give you this information. So I'm gonna give you the third platform, which is gonna pretty much you where you can find all the fundamentals and if they're going to be good, if they're going to be strong, if they're not going to be strong. This is so you can know exactly what's gonna happen in the news section of trading. With my strategy and how I trade, I don't use this at all. But at the beginning, when I was learning to trade, this platform made things so much simpler that all I had to do was just go to this one place and I would what's happening for the next 2 to 3 weeks with news articles, and it would simplify things a whole lot. So we don't trade with news. We don't need it at all. But I'm going to explain to you how you can simply learn how to read it if you're simply curious about it and you don't have to waste time looking at other platforms and simply just wasting your time. This one platform does absolutely everything. Now, this next platform is going to be on forexfactory.com. So again, this is not a paid promo. I wish these guys would be paying me right now for this video. They don't, but they've been around for years, even before I got started. So this is Forex Factory, which is going to be the platform that will tell you exactly the news that is going to be happening in the markets. So you would want to come here to calendar of the actual Forex Factory. As soon as you come to the calendar, you would want to then click over here, this filter section. And on this filter section, you want to then only have favorited the red news articles. You can have favorited all of them, but they simply won't be effective. These are all different type of news articles that are going to come out. They're going to simply affect your trade for good or for bad. You simply will never know. I have tried to create an edge around this and it never works because you never know what's going to come out on the news. You can have an idea, but you're never going to have absolutely any idea. There's no facts behind that. You don't know what's going to happen until the news comes out and says what's going to happen. So there's simply no reason you should be wasting your time here, but it's a good way to get educated and just simply be aware of when it's going to be coming out. So back to the platform, you guys can see how it tells you the day that the new article will be coming out, and it will be telling you the time along with the currency pair that it's going to be affected and the impact that it will have and what it is related to. As you guys can see, they have a potential forecast of what they believe it can be and what the previous time there was a news article like this was, and then the actual outcome, but the outcome only happens after. If I were to simply go to the next week, let's say if I were to click here on this week, you guys can see how Sunday, April 7th at 7:30 in the afternoon, there's going to be news about the Japanese yen with a yellow impact news, which really does absolutely nothing. It's literally somebody probably coming out and saying, hey, we're doing great, or hey, we're doing cool. It does nothing. So this is a news about the average cash earnings, which as you can see, the previous time it was 2.0%. They forecast, they believe for it to be 1.8, but the actual you don't know until the news comes out. Usually, sometimes they're good, sometimes they're accurate, but at the end of the day, it does nothing for your trades. If you notice right here, they predicted this one pretty well. They predicted this one pretty well. And these are all different types of ways that you can simply confirm if your trade's going to be going in your favor or going against it. I don't know. I don't really ever look at it, but this should be the only one-stop shop platform that you should look at if you're interested in looking at any types of fundamentals when it comes to the news. And if you notice, if you just want to focus on what matters, you simply come here and you exit it out of all of the news articles that are not the red ones, because these are the only ones that will have impact towards your trades. And the only section that I look at on Forex Factory, I have never used the forums, the trades, the news section within itself, the market, the broker, like none of these stuff I have ever used inside of Forex Factory. I only used to come in here to know when is a news going to come out and at what time, and does it affect my trade. And I know this might be something very direct and you might not make any sense right now, but I will circle back to this later into the video when we're actually entering a trade, when we're gonna have our percentage-based entries, and there you can add this or not add it. But this is basically a one-stop shop where you're gonna pretty much know that some things can potentially go down X date at X time, and they're gonna be talking about X type of currency pair. Now, if you want to use it to your advantage, you could, but just know that there will never be absolutely any guarantee that you can create an edge on it, because there is clearly no confirmation until the news comes out. So far, we have 3 different types of platforms. The first one is going to be TradingView. This is where you're going to physically be seeing the actual markets. The second one is going to be MyFXBook Position Size Calculator. This is where you're simply going to be calculating the risk that you are going to determine if you're going to take the trade or not. And then the third one is going to be Forex Factory, which is going to be if you want to then use news to your advantage, or if you don't, or if you simply just want to be aware of when there's going to be news so you can avoid getting into a trade. These are the 3 platforms as of right now that I have been using for the last 6-7 years, and they have worked perfectly. Next, I'm going to be talking about one more platform, and it's the platform where you actually execute the trade. And this is going to be MetaTrader 4 and MetaTrader 5. I'm sure you guys have heard of it before, or you guys have seen screenshots of these gurus showing $25 million on a phone and all this stuff. And this is actually a very well-known platform. It's pretty much what 99% of the industry uses. It's actually the only platform I have ever used, and it is very simple and it is very straight to the point. And this is where you will actually be executing the trade. So if you analyze a trade on TradingView and you calculate your risk on MyFXBook, where do you actually plug in your trade? Well, you'll be plugging in your trade on MetaTrader 4 or MetaTrader 5. What's the difference between Meta 4 and MetaTrader 5? MetaTrader 4, think of it as the iPhone 11, and MetaTrader 5 as the iPhone 15. It's simply a much bigger, updated, and newer version. I personally still use MetaTrader 4. I like it. It's very comfortable to me, and I don't have a reason to update to the next one. I simply like it. Some people like the newer one, some people like the older one, to each one, but they both have the same exact functions. MetaTrader 5 looks like an updated newer version. MetaTrader 4 simply looks like the first version. The buttons, everything is absolutely the same. The speed, execution, everything is exactly the same. So there is a web version of this, which is for a computer. And then there is a mobile version for this, which is for your phone. This is pretty much where you see the majority of people doing it. I have only done it on the mobile. I did it 3 or 4 times online. I didn't really like it. It's like very old, but I like it on the phone better. It's very accessible. It's very straight to the point. So this, I'm going to actually teach you how you can use it when we're going to take a trade together in this video. So you have to make sure you stick throughout the whole entire video, because we're going to actually take a trade together with what I'm going to teach you. And as soon as I'm going to take the trade, then I'm going to show you how you can use the platform to your advantage. So now that we added MetaTrader 4 and MetaTrader 5, this is where you're going to actually execute onto the trade. This is where you're actually going to enter the position that you're analyzing on TradingView. Now, these are all the platforms that you are going to be using pretty much every single day. Now, there is one other platform, and that is going to be a broker. So a broker is pretty much the middleman in between you and the market. So you can't simply right now decide, all right, I'm going to go into the market and I want to trade USD and put a buy. That's not how it works, because the market doesn't accept retail traders, because you need to have hundreds of millions of dollars to get involved in a $1 trillion market that moves that every single day. So that's where the broker business came, that the big markets give liquidity to the brokers, so then you can execute smaller positions as a retail trader, which is what you are watching this video, what I am, and what pretty much 70% of everybody inside of the market. The big banks are the main ones that move the market. Retail traders don't do much. So this is where the broker is going to give you a fee for executing your trade into the market. So picture you over here wanting to enter a trade. And then this is Euro USD, the trade that you want to enter. You simply can't just go from here to the market. It's not how it works. There has to be a middleman, and that is going to be the broker. So you have to go to the broker, you tell the broker the trade you want to take, and then they will execute into the market. So the way that this used to work before used to be based off of phone calls. So people would simply get on a phone, call the broker and be like, hey, execute this trade for me. This is where I want to get out if I'm wrong. This is where I want to get out if I'm right. And that's where you would see the Wall Street people pretty much, running everywhere on the phone with these paper slips, because they would have to go to the broker with the slip so they can execute the trade for you. Well, that was like 100 years ago. That's not how this works anymore. The way this works now is simply through a couple of touches on your phone, because obviously that method wasn't being super productive and it wasn't targeting the masses of retail trading. It was a legit mission. So the way that it is done now is you simply go to a broker, you deposit your money into a broker, and when you deposit money into the broker, you simply find the currency pair that you want to take the trade with, and you execute the trade. Now, you're going to see that immediately when you enter the trade, you're going to be negative in a position. Why? Well, that's because the broker business is on a spread. In order for them to connect you from the broker to the market that you want to be trading, they charge a fee. And that fee is going to come immediately as soon as you take a trade. It's simply how the industry works and how the broker business works. And the simplest analogy that I can put are like tolls on the highway. When you want to get from point A, which is your house, to let's say point B, which is going to be, let's say, the beach. In order for you to get there, you have to go through the highway. You can't just simply cross from your house to the beach. No, you have to go through the road. And in the road is going to be a toll, which you have to pay a couple of cents or $1. Obviously, depends what country of the world you're in, if you even have tolls. And this toll is going to charge you a fee so that you can get, obviously, to your location. So this is a simple example of how to understand what the broker does. Obviously, the toll does nothing for you. You have to drive yourself to the destination, but it's the cost of you having to go to the beach. Whether you get to the beach or not, you still had to pay that toll. Whether you win or not, you still have to pay that fee to the broker because they executed you into that trade that you wanted to take. Now, what broker should you use, or what broker do I use? So I am not going to recommend anybody to any broker. There's 100 million brokers out there. There's 100 million regulations. There's 100 different million everything. I personally do not want to recommend you to a broker simply because I don't want to have any affiliation towards where you put your money into. I don't want to get paid off of a code. I don't want none of that stuff. And trust me, it would be really nice for me to do that because I can easily make hundreds of thousands of dollars a month by referring you to a broker. But I'd rather take the more genuine route and just simply let you do your own due diligence, and wherever you decide to go, you can go there. I make my money trading, and I want nothing to do with affiliation to brokers or to any platform that I simply have no control over, especially if they're going to be receiving your money that you're going to be investing to then scale. So I'm not going to recommend you to a broker, but simplest things that you should look for a broker is going to be regulation and reputation. You don't want to go to a broker that is just getting started, and you don't want to go to a broker that is not regulated. It is not worth it. You want to go to a broker that has regulation, so they are at least held liable if something happens. I'm sure you've seen the biggest exchanges go down, the biggest brokers go down. Imagine how that works for unregulated brokers. Those things disappear in a heartbeat. So you want to make sure that you only go to platforms that are regulated and have the best reputation possible. But if you were to literally put a gun to my neck, if you go like this, the only broker I would ever recommend, and I'm not getting paid for this at all, would be Oanda. Oanda is the most regulated platform pretty much on the face of the earth, and the only one regulated in the US. Kind of sucks because they lower your leverage and they have a lot of restrictions because they're a super regulated platform, but your money is as safe as it could get there. If you want to know more about broker, please go do your own due diligence. And if you want to then find a broker, make sure they have as close to the requirements as Oanda does. So now that we understand all the different platforms that you need, the platforms that you're going to use, the ones that you're not going to use, what platforms should you avoid? And the platforms that you should avoid are absolutely all of them that are not these four. You do not need to look at any other platform that has not to do with these right here, because they are simply extra. They have overload of information, they are unorganized, they are excessive, and you don't need them to be successful. I have tried hundreds of them and they have been a simply waste of time and waste of energy, waste of resources, waste of money, everything. You don't need a trading journal right now. You don't need a place to track your trades. You don't need any of that stuff right now because you simply don't even know how to trade just yet. So how do you know what you're tracking is going to work for your benefit or if it's going to work against you? So you don't need any of that stuff right now. And even to this day, I don't journal or track my trades how 99% of the retail traders that lose every single month track their trades. I track them in a very different way, and I'll also explain that later into this video. But there's not going to be any other platform that you will be needing other than these four that I have just explained. So you want to avoid every platform outside of these four, simply because they're not going to do anything to your trading and make you any more successful if you were to add it to your trading system. You do not need it. I don't use it, and the thousands of my students don't use it either. So now that we understand all of that, let's talk about the different types of trading, because with the information that I have shown you, you can trade many different types of ways. And I'm not talking about technical ways or stuff with the charts. I'm talking about actual trading concepts. There's many of them, and these are the most known ones. The first one is going to be price action trading, which is going to be the charts that I have just shown you guys. It's these candlesticks that go up, that are blue and red, and the candlesticks that go down, or the line chart that goes up and down. The ones that we just explaining just a couple of minutes ago, that pretty much represents the feed price of that currency pair happening inside of the markets. This is going to be price action. This is how you can physically see where price is on real time in front of the chart, and everything that happens in the history, meaning the candlesticks that are left in the past or the lines that are left in the past. This is pretty much like the trail of where this price is headed. This is the battle in between both currency pairs, and they're leaving a trail behind when they're going up and when they're going down. And those trails you can use them to your advantage because there's patterns behind those trails. And this is the most known common way of trading, simply because it's the easiest way to spot patterns, because you can literally see them. You're seeing it happen again and again and again. And you're looking at these patterns through the way of price action. Price action, technical analysis, charts, it's all the same thing. You're looking at the chart, which represents price that the market is showing you in a form of a candlestick. Next is going to be market sentiment. So this is a type that I learned very early on, and I had extreme failure like this because it's kind of a crazy trading concept, and it simply consists of you trading against the majority. That's pretty much it. And there's websites out there that can tell you where 99% of the retail traders are. And since 99% of the retail traders fail, you simply do the opposite of what they do. So if 99% of the retail traders are buying, you will simply sell. That's it. That's what market sentiment trading is. It's honestly a very high risk way of trading, and there's a lot of speculation because none of these platforms really know how many traders are in one direction versus the other. It's great assumption and it doesn't work. Obviously they get their price data and live feed from brokers and from other platforms, but how reliable can that really be? I tried it and I've heard stories and I've never met anybody that is successful with it. But pretty much what you're doing is you're trading against the retail traders, but you're not having an actual price that you are looking at. You're not looking at the candlesticks. You're not looking at the charts. You're not looking at technical. You're not looking at any of this stuff. You're just basing it off of one platform that tells you, hey, 99% of the traders will be buying tomorrow at 9 a.m. You should sell. But how do you know where to place your take profit? How do you know where to place your stop loss? How do you know if the entry is right? How do you know if you even have an entry signal? There's so much stuff that gets factored into this that simply makes absolutely no sense. And you're pretty much just trading off of an assumption of a platform, which to me had no sense. And I see no reliability and accountability for you to become successful using this source. Next is going to be fundamental analysis. So this is pretty much what we just explained just a little bit ago on Forex Factory. And this is going to be where you simply trade using the news. So some people out here, they love reading hundreds of pages every single morning, or they love being on top of what politicians are doing, and they study them and their moves and their team's campaign, and based off of what they've done in the past, they can pretty much assume what they're going to say in their next speech or what the next political news is going to come out, and they use that as a trading strategy to pretty much create an edge over the market, where they believe that they can know what these politicians and what these big news are going to pretty much post. But it kind of takes as well as a lot of assumption, and it's a lot of assumption based off of articles that you have to read that you don't know if some of these articles are reliable. You guys know that the media kind of makes a lot of stuff up all the time, and they give their own twist to the story. And I personally didn't want to have any reliability on social media that they can just spiral up the news to make it a little bit more spicy and they could get more attention, and me base a money decision based off of that. Or you simply have to read 5-6 different news articles to pretty much come with one overall decision if it's going to be good, if it's going to be bad. You're pretty much just basing everything off of reading. And instead of you reading actual letters, why shouldn't you actually be reading actual charts, which is what the market does? By you reading fundamentals and you're reading the news, you're not seeing patterns, you're not seeing anything. You're just pretty much reading what the people think is going to happen. And then you making a business trading decision based off of that. And that's what the fundamentals pretty much consist of, just you reading news and base a trading decision off of that. So instead of you relying on the charts, on the candlesticks, you're pretty much relying on the news, on politicians, on social media platforms, places that direct what the news of that currency is going to be, whether you believe it's going to be good or whether you believe it's going to be bad. But same exact thing. How do you know when's the entry signal? How do you base your stop loss off that? How do you base your take profit? You can't really base it off of something like, let's say you even know for a fact that some politician is going to come out and the news article is going to mean that the dollar is going to get strong. Let's say you know that for a fact. You have inside information. Well, what do you do with that information? How do you know where your take profit is going to be if you're not physically looking at a chart? And that's why the fundamental traders usually have a big struggle becoming profitable, because they also have to implement technical analysis for it to make some type of sense. So these are going to be the 3 different types of market approaches that you can decide to trade the market in. And for the remainder of this video, we're going to simply and solely only focus on price action trading, because it's what I have been using to become successful. And it's what 99% of the traders at the end of the day have to come back and trade, because you need to know where you're going to place your entry point, your stop loss, your take profit, so on and so forth. And don't worry, I'm going to get into a lot more detail on what these terminologies are. I just need you to know exactly what we're going to be learning so you can learn these terminologies with the type of trading that we will be doing. So now comes the official first step of technical analysis and price action, which is going to be trend. And now let me just say this right now, and you guys can literally get a sticky note and write this down. The trend is your friend. The faster you know this, the faster you will become successful. And I wish I paid attention to this at the beginning. If I would have done this at the beginning, it would have saved me so much time, so much money, because I wanted to be that guy that went against the trend. And if you were to just think about this outside of trading, when you think the trend is your friend, the first thing that should come to your mind is the ocean current. If the ocean current is going east, you simply swim east. If the ocean current is going west, you swim west. If the current is going west and you want to swim east, you're gonna have a really hard time. If any of you guys have ever been out to the ocean and swam against the current, what ends up happening is that you simply don't move. You stay in the same exact spot. You stay in the same exact spot and you have no success. Well, that is exactly what happens with the market. But when you go with the current, you make money. And when you go against the current, you lose money. When you go with the trend, you make money. When you go against the trend, you lose money. The trend is your friend. This is the number one thing that you need to know. And it is the most important thing when it comes to my trading strategy. And it just happens to be the first thing that we're going to be talking about when it comes to technical analysis. So now, how do you identify a trending market? It is very simple. So as you guys can see, if we come over here to the chart, you can identify a trending market by looking like this. You can simply tell this is a market heading to the upside because it is clearly heading to the upside. And then you can tell this is a trending market to the downside because you can clearly see it heading to the downside. So this right here is a bullish market. And then this is a bearish market. This is a bullish market right here. And then this is a bearish market. So bullish means buys or up. Bearish means sells or down. And this right here is consisted of different types of words that make it a bullish market or a bearish market. And this is going to be higher highs and higher lows. Let me just type it in. So I need you guys to understand these principal rules right here of identifying a trend. And this is that a bullish market is obviously buys and means that the market is heading to the upside. And this market is consisted of higher highs and higher lows, which is a short abbreviation is HH, which is higher high, and then higher low, which is abbreviation for higher low. So then a bearish market is obviously for sells and indicating that you're going to the downside. And this is consisted of lower lows and lower highs. Obviously the abbreviation for LL is lower low and the abbreviation for LH is lower high. Now I want you to remember it is impossible to have a bullish market without a higher high and higher low, and it is impossible to have a bearish market without lower low and lower highs. It is absolutely impossible. Same way how it is impossible to have a ocean current going east without the waves creating the crevices going east. And it is impossible that the ocean current is going west without the ocean crevices going west. It is the same exact thing. And this is how you identify whether the trend is bullish or whether the trend is bearish. Now, this is going to be very important that you understand this, because when you mark off the higher high and higher low, which I'm going to show you in just a second, you're going to be able to tell when the trend changes from bullish to bearish or from bearish to bullish. But the only way for you to be able to identify that is if you can identify the higher highs and higher lows. So let me explain. Higher high should be very self-explanatory, and that's pretty much going to be the highest high point. So that is going to be off of this point right here, and we're just gonna double click this line. We go to text and we simply just type HH inside of this box right here, which is going to be the abbreviation short for higher high. So we know that this is the higher low. And where is the higher low? Well, it's the last higher low, which is going to be this point right here. So I'm simply gonna copy and paste this line. We come here and we click and adjust as a higher low. Now we understand that this market is bullish because of this higher high and this higher low. It is impossible to have a bullish market without a higher high and a higher low. And if we were to have our bearish market, obviously the lower low would be the lowest low point, which is this one right here. Simply double click it, come into the box, and we're going to put lower low, which is the abbreviation for right here. And then for the lower high, we're just gonna copy and paste this line, put it at the last lower high, which is at this point right here. And we're going to put lower high because it's the last lower high. Now, obviously I'm going to explain now how to identify these points, and now it gets a lot simpler. But so you have an idea is picture the last move of the market as the last wave before it hits the shore. That is where you can start counting the amount of waves that the ocean is showing you within the vision that your eyes can see. So if I were to simply come over here and show you at a picture example. So as you guys can see in this image right here, the last wave before hitting the shore would be this one right here. And you can pretty much count the following waves that are going to be hitting the shore. So this is the first wave, this is the second wave, this is the third, and then this is the fourth wave. So this wave right here has the highest point of the wave, and then it has the highest low point of the wave. This is where you can pretty much measure and identify how close the wave is from hitting the shore and how close the wave is from the last wave. It's a way for you to tell where is the highest point of the wave and where is the highest low point of the wave. Obviously in this example of the market going to the upside, and then we just simply flip it over vice versa for it heading to the downside. So we know that this is the closest wave to hitting the short. So when we go back to the charts, this is the closest market structure trend to being at the live price. So now that we understand that it is impossible to have a bullish market without a higher high and higher low, and it is impossible to have a bearish market without a lower low and lower high, let's just remove this, right? So we can focus on what matters, which is the trend. So let's say this market creates something like this, and it does this. Well, this means that this market has clearly now created a new higher high. So we have to adjust our higher high to the new highest high point. And in the higher low, we have to adjust to the newest higher low point, which is going to be this point right here. And then this market can pretty much do this forever as long as it continues to go to the upside. And this market will remain bullish as long as we remain within the higher high and higher low. Meaning this market is bullish permanently forever until we are above the higher low point. The moment we close under this line and the market does this, we have now shifted the trend of the market. So now this market is no longer bullish. Now this market is bearish. There has been a change in the trend. There has been a change in the currents. I'm sure we're all familiar when we've been at the beach. Sometimes the waves are coming to the east and sometimes the waves are going to the west. And if you guys have been at the beach long enough, if you go early in the morning, the waves are going a certain direction because it's getting the overnight current. But then towards the afternoon, when it comes to sunset, the waves are now going in a completely different direction because the current has changed. Well, this is exactly what happens in the market. The market could be going to the upside and then it can change to the downside. And the way you can identify the trend shift is by these higher highs and higher lows. And this is how you can understand where the trend is going, if the trend is going up or if the trend is going down. And then this right here will be pretty much the same exact thing when the market is to the downside. As long as this market stays in between the lower high point and it does this, this market will continue heading to the downside, and this will turn into the new lower low, and then this will turn into the lower high. The moment we close above that lower high, this market has now changed from bearish to then bullish. So then this will become the new highest high point, and then this will become the new highest low point because the market trend has now shifted. And again, I'm going to get into a lot more detail in this later into the video. I want you guys to understand how to spot a trending market. Now, these trending markets are in absolutely every single pair in the market, every single time frame, everything, right? They come in all different types of shapes and sizes. Same way as the currents in the ocean. Whether you see big waves or whether you see little waves, whether you're looking at a very small section of the ocean or whether you're looking at the whole entire ocean, there is currents all throughout the ocean. There's the overall currents from the Pacific Ocean, and let's say that can be going west, but when you zoom into that section within the Pacific Ocean, you can have variations of it going east, north, south, west, however the wind is taking it at that point. So it just depends on what section you're looking at that will identify what way the current is looking. And to explain this now in the trading market, a currency pair Euro USD, which is like the Pacific Ocean, depending on the time frame you look at it, the trend can be going north, south, east, or west, or it could be going bullish or bearish, right? There's no north, south, east, or west in trading. It's only going to go up or it's only going to go down. So it's actually a lot easier to identify if a pair is going up or down than seeing if the ocean, what way the current is taking it. So now the trend itself is actually consisted of something called market structure. Now, market structure is pretty much like the crevices of the actual wave. So if we go back to the image over here, you can see that this wave is built because of these crevices and these bubbles and what creates the wave, which is the details of it. Well, it's the exact same thing when it comes to the actual trend of the market. The market is built off of details, and those details are called market structure. And market structure is what we will be trading. And what you're currently looking at is market structure. And market structure is every single point that looks like an elbow, that looks like a triangle, looks like a pointy thing, however you want to identify it. Every single point that looks like this is consisted of market structure. And as you can tell, the market is heading to the upside or heading to the downside because of these market structure points. This is where it identifies where the market has had a rejection from that point, whether it's to the upside or whether it's to the downside. Let's say this market right here decides to then do this. That has now created a market structure point. This, as of right now, is not a market structure point. Why? Because it has not created the actual market structure point. This right here can simply continue heading to the downside, and then from here, it decides to then do this. Well, now this is a market structure point. Not these points in the middle where there is no elbows, where there's no triangles, where there's no pointy sections. That is not market structure. That is just price action. Price action is just the price going up or price going down. Now, when price goes up and when price goes down, it leaves a trail. And that trail is consisted of market structure. And every single point the market has a reversal point is a market structure point. Same thing from here when we are headed to the downside. Every single one of these points are going to be market structure. Not this zone right here in between. This is not market structure. 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 Market structure are these pointy elbows that the market has had a reversal, indicating that it is going to continue to the downside or continue to the upside. It's wherever the market has had a reaction from. This is going to be very, very key because we're going to be entering trades off of market structure. So if you're tired of me saying market structure, just hit the subscribe button, because I think I said it 100 times. And the reason why I said market structure points so many times is because it's going to lead us to our next point, which is going to be support and resistance. So now remember, support and resistance, if you were to think about it having nothing to do with trading, what does that mean? Well, if I were to want to push off of this table, I'm using this table as support to then go to the upside. If I want to pull myself down, I will use the bottom of the table as a resistance area to then push myself down. So you are using support to push yourself up, and you're using resistance to push yourself down. Well, this is exactly what the market does. The market uses support points to bounce and head to the upside, and then it uses resistance points to reject and then head to the downside. If you're buying, you're using supports. If you're selling, you are using resistance. Resistance is to go down, support is to go up. If you're going up, you're buying. If you're going down, you're selling. And this is very simple because an area of support can be used as resistance, and an area of resistance can be used as support, just as how I use this table. I use it as support to push myself up, and I use it as resistance to pull myself down. It is the same area, and I use it as support and resistance. So if we come to the market now and we were to identify a chart, we would come here and we can simply see that a support level would be where the market has had multiple rejections from. So this right here would be a level of support, because you can see this is a zone where the market has rejected multiple times from. This is a level of support. And then this level right here, clearly the market has rejected multiple times, and this is a level of resistance. Now, keep in mind, it's never going to be perfect right to the T. Obviously, the market moves in candlesticks, so you're gonna probably have a little bit of margin up, margin down, but we'll get into more details there. But level of support is where price has rejected from the bottom to push itself up, and then resistance are where price has reached the roof and has used it to push itself down. So for example, if price were to be here right now, it would use it to then push itself down, and if it were to come to this point, it would use this point as support to then push itself up. So this is a classic level of support and resistance. And this is extremely important that you understand what is a resistance level and what is a support level, because we are going to be entering our trades off of a support or off of a resistance level. As if I were to have to push myself up, I would need something in order to push myself up. I can't just push myself up out of thin air. I'm not Superman. I don't have those powers yet. I need a platform to push myself up. So I need to identify the platform that could withstand my weight to push myself up. If you're looking to buy a trade, you need to identify a strong level of support that is going to withstand the market and push your trade to the upside where you're looking to buy, where you would make money. And this leads me to my next point, which is going to be area of interest, or also known as a level of supply and demand. As you can just see, I've identified this table as an area of interest where I want to use it to push myself up or pull myself down. This is my area of interest, what I'm going to be using. Now, this is exactly the same thing that you will be looking at the markets when you're looking to buy or when you're looking to sell. An area of interest is an area that you want to identify strongly to go up or strongly to go down. So if I were to show you right here when we come back to the charts, you can see that if I were to be having this spot right here, price having a pullback, I would identify this as an area of interest, because every single time we come to the zone, we are rejecting and we're going to the upside. So I would place a buy here. And if the next time we come to this point right here, I would use this as an area of interest because we have clearly rejected it multiple times, where I'd be interested in selling it to the downside. Now, the only way you can identify an area of interest is if you have a minimum of 3 market structure rejections. So this right here is a perfect example of an area of interest because we have more than 3 market structure rejections. As you can see, this right here is a market structure. This right here is a market structure. And then this right here is a market structure. So if we were to come back into this point, this is a valid area of interest. Same thing if we were to come here as resistance, this would be a valid area of interest because we have more than 3 touches from this level of resistance, which would be qualified as our area of interest. So an area of interest has to have more than 3 touches to be a valid area of interest. A minimum of 3, anything above 3 is obviously better. The more, the better, because it means that it is more respected. So when you're going to use this as an area of interest, it's going to work to your advantage a lot better. So you want to make sure that you're using the current price as an area of interest. So for example, let's say if you were to have the chart like this, and if you were to only have these two and you would not have this and you wouldn't have any of these, you cannot use this as an area of interest because it only has 2 touches. It does not have 3 touches. This is a touch as a support level. But since you are at a resistance level, you're interested in selling. So you need 3 touches of the resistance level to then enter the trade. You can't use a level of support to add as 3 touches. That simply just makes no sense. You want to make sure you have 3 touches of the resistance level in order to take the trade. If you don't have 3 rejections previously, you simply don't have a valid area of interest. Even where price is right now is not considered a rejection because we don't know if this has rejected it. We're looking to enter the trade before it does. So if this were to do this, this is a valid area of interest now because this is the 3rd tap. So this is what an area of interest / supply and demand consists of. It consists of an area that has more than 3 touches of market structure. Next is going to be round psychological level. So make sure you guys pay attention because this is actually the easiest one and it's the most straight to the point one. When you think round psychological level, the first thing that should come up is a round number. So every round number is going to be every 100, 200, 300, 400, 500, 600. It's every round number to every 100th. So this is exactly what we look for in the charts because the markets have reactions from these round psychological levels. Think about it. Let's say you were to be an institutional bank where you are moving trillions of dollars every single day. Do you think that you would decide to liquidate your positions at a random price point on the chart? Let's say 1.5321. No, that's not ideal. You want to liquidate your positions at a round psychological level. So all your positions are closed equally and you have everything organized. So you would close your position at 1.5 thousand. That is a round psychological level. Or you would close it at 1.5500. Something that is a round level and that all the positions can get liquidated at the same exact points and you can keep it on your books and you don't have just a random number out there on the charts. So round psychological level on the charts are actually very easy to identify. All you have to do is get your horizontal line and you can simply just throw it wherever in the chart. And you double click it and you will go to coordinates, and when you are in coordinates you simply round it to any 100. So for example, this is 1.77102. You want to round this off to 1.77100. So you would round it off to the 100th and you would simply click OK, and you can see how now it pops up on your chart as an identified round psychological level. You can come here, throw it another again randomly into the charts. You would go to coordinates and you can see here how we have 1.76805. So you would erase the 5, you would put a 0, and now you have a round psychological level, 1.7800. And you can pretty much just do this on every 100. It's very simple. It's almost kind of fun. 1.76353. So you want to round this to the 100. So obviously this is above the 50 mark. So you would round this off to the 400. Or if you want to round it off to the 300, or because where you placed it, it was above 50, you can then round it off to the 400. The point is that you need to have it closed at a round psychological level. It is every round number. You don't want to have a bunch of random numbers. You want to keep everything very clean, very straight to the point. So now that we understand round psychological level, the next subject is going to be the Japanese candlesticks. So Japanese candlesticks is what we have been looking at in the charts. There are these candlesticks, these boxes that they're blue or green when going up and red when going down. This is very important because these are the candlesticks that we will be trading when you're looking at price action, when you're looking at the market trend. Everything is going to be based based off of these candlesticks. So it's very key and very important that you pay attention to how these candlesticks work. So let me explain to you how these candlesticks work, because these are the candlesticks that leave the trail on the charts, that leave the footprints, leave the patterns. This is everything that we will be basing our trading strategy on, and how you're going to execute trades on the market based off of these candlesticks. When you have these candlesticks all accumulated, and they create a trading strategy. So if we look at this image right here, this is what a candlestick consists of. A candlestick consists of a high point, consists of a close point, an open point, and a low point for a bullish candle, and then a high point, an open point, a close point, and a low point for a bearish candle. So every single candle has to open and then it has to close, and every single candlestick has a high and has a low, or a low and then a high. It's the same exact thing, just one is bullish and one is bearish. So as you guys can see right here, this green box is called the actual candlestick. This is where price opened, and this is where price closed. Now this can be the 1 hour, the daily, the weekly. This candlestick that we are looking at can be in absolutely any time frame, because every single candlestick is the same. The only thing that changes is the actual time frame, but what the candlestick consists of is the same for every single different time frame, and we just discussed the time frames earlier in this video. So this high price is the trail of where price was. So this candlestick, well, this box was actually up here at one point, and then price was pulled back, and that wick is the trail of where the price was. So this is where price had pushed up to, and then price came back and it closed at this point. So as well, from this point, when price opened, price actually pushed to the downside, but then the buyers came into the market and then pushed the price to the upside. But this is where the price closed, leaving a wick on the bottom and a wick on the top. The wick is pretty much a different term as used for trail, because let's say that I were to be at the beach and I were to get a stick and I simply move the stick up on the sand and then I move it down. You guys can see that there is a trail that I left with the stick, but where I last leave the stick, that's where the stick stays. Well, that's when price opens, it goes up, it leaves a trail, and when price goes down, it leaves a trail as well. And where the price last closes, well, that's where price stays. So these wicks on the high or on the low is the trail that the actual candlestick has done within that hour of whatever time frame you are looking at. So let me actually just show you in the charts right now. So this candlestick right here, which is the last candlestick, this candlestick had opened at this point right here, and then price had been pulled down just a little bit, and then price was pushed all the way up to the upside to the high of that wick. Then a little bit of sellers came, and then this is exactly where price has then closed. So when the next candlestick opens, it is going to open like this. It's going to open where this price was closed at last. And let's say as soon as it opens, it decides to go to the upside, but then it decides that the sellers are stronger and it's going to push down. It simply can't just like this, because the price actually pushed up. So it's going to leave a wick at this point right here. And this is where the price was at. So if price pushed all the way up to this point and then it pulled back down over here, then that is the trail that this price leaves. And if this keeps pushing down to, let's say, this point, and this is the lowest point this candlestick made, but then it decided to pull all the way back up to here, well, it's going to leave a trail, which is the wick, that the price made it to that low point when it was fluctuating. So this candlestick would have done all of this within the daily time frame, meaning it decided to move up all the way to this point, low all the way to this point, and then close at this point within 24 hours of this candlestick. And then let's say the next one, it opens where this one closed. So if this one closed at this point, then the next one will open here, and let's say it goes a little bit to the upside. So then this would be the highest point it was. And then let's say it just decides to push down, it will leave a little tail right here. And then we will continue to then head to the downside. and let's say it goes all the way up to this low point, and it decides to have a little bit of a pullback to, let's say, that point right there. Well, then this would only have a wick this size, like right there. And then at the next candlestick opens where it closed, if it closed here and then it heads to the upside, but first it did a little bit like this, well then it would leave a little bit of a wick to the downside at this point right here. And then if it closes to the upside, let's say it went all the way up to this high, that's the highest point that candlestick made, and then it decides to have a pullback to this point, well then it will leave a wick right here, which is going to be the trail that that candlestick has left. So basically, when a candlestick opens, it's going to push up or down, and wherever it decides to go, it's going to leave a trail, which is going to be the wick. So now that you understand how the candlesticks work when they open and when they close and the trail that they leave, it leads me to my next point, which is going to be candlestick patterns. So this is where you have a mix of the actual candlesticks and then price action, where they create a pattern in the markets. These patterns are used as continuation patterns. They're used as reversal patterns when you're taking a trade. You're going to add this as a confirmation or another reason to take a trade, because you're seeing this pattern happen time and time again. And these patterns will identify if it is a trade continuation pattern or if it is a reversal pattern. A trend continuation pattern is pretty much what it says in its name. It's a pattern to indicate to you that the trend will continue to go in its favor. And then you have a reversal pattern, which is a pattern that it's going to indicate to you that the market is now going to reverse. Whether you have a market at a high that is going to indicate to you that now the market is going to reverse to the downside, or a pattern at the bottom that it is going to indicate to you that the market is going to now reverse to the upside. Or if you have a trend continuation pattern, it's a pattern that if the trend is going up, it's a pattern that will indicate to you that it will continue to going up. Or if you have a trend continuation pattern to the downside, it's a pattern that's going to indicate to you that the trend is going to continue going to the downside. And this is very important because if you're looking to trade with the trend, you want to trade with the continuation pattern. And if you're looking to trade against the trend, which I don't ever recommend, you're going to use the reversal pattern. Or if you see this pattern, you know not to take a trade if you're trading with the trend. For example, let me show you the most effective and my favorite reversal pattern in all of the market, and you'll see how often you can actually see it in the charts. And it is going to be the head and shoulders pattern. So as you guys can see right here, this pretty much looks like a head and shoulders or three peak mountain, whatever you want to call it. The actual proper terminology is head and shoulders. As you can see right here, this is a left shoulder, this is a head, and then this is a right shoulder. And if you can see, all of this is an accumulation of both of the important things that I have taught you. One, market structure, and two, candlestick patterns. So as you can see right here, this peak, this elbow, this pointy point, this triangle, this is a market structure point. This is a market structure point. This is a market structure, market structure, market structure. And as you can tell, this market structure created with the candlesticks has created a head and shoulders pattern. So if you see a head and shoulders pattern at the top of a trend, this is a reversal pattern. This is going to indicate to you that now the market is going to head to the downside. So the market is no longer bullish. If you see the head and shoulders at a resistance point and at a high point in the market, this is an indication that the market is now going to reverse. So if you were looking to enter buys, you should no longer enter buys because you're having a reversal pattern. And then its brother or its sister is going to be the inverted head and shoulders, which is literally the same exact thing, just opposite. So an inverted head and shoulder happens at the bottom of a trend where you will have the same exact left head and then right shoulder. This is where it's consisted of market structure, market structure, market structure, market structure, and market structure with the candlesticks that I have just explained to you, and it creates an inverted head and shoulders, which happens at the bottom of the trend. And as you can see, when the formation happens, the market now heads to the upside because this is a reversal pattern. And it's very important for you to understand